Hi guys, it's Doc's Market Minute for Friday, December 18th. Okay, so finally, after a long time here of interference, the Fed is out of the way. They did their job. They hiked the rates as they said they were going to do for a long time. So now what? Well, now what is, it's turned into somewhat of a sell the news environment, because now what's happened is the market is looking externally to say, all right, the market's on its own now. Do we like what we see? The Fed's not going to be doing anything one way or the other now for probably a number of months. So here's number one, is the market character that we have, the market character. Now, most people, when I say market character, have no clue what I'm talking about. Well, I think you can clearly see that when we've had this rally here throughout most of 2013 and 2014, all the way up to the beginning of 2015, generally this is what's called a quiet and trending market. This is where we have very low implied volatility. We don't have much realized volatility in the market. In fact, this move here in October was really the first move that we had since 2011 that was anything close to a 10% correction. So it took that long of uninterrupted, very low volatility markets for this to occur. 3 years. Now, of course, as we know, the majority of this was caused by quantitative easing, where the basically the Fed sticking in $4 trillion into the market. So now they've stopped, now they've tapered and are starting to pull back from the quantitative easing and the monetary stimulus. So now what's left? Well, if you look at this whole period in here, especially what we've seen since August, right? So we saw a very quiet period in the spring to the summer. Okay, that is a very rare condition where we have quiet and sideways price action. We don't see that very often. In fact, the last time we saw that was maybe 10 years ago. All right, so now we've got what's called volatile and sideways price action. So all of this that we've had really since the late August has been volatile and sideways. And you can see that it's clearly different from this sort of one-way freight train where we had this every day we woke up to the same thing. It was Groundhog Day again and again. We'd dip a little bit in the morning and then we'd recover the dip and then end up a few points higher. So now we have this stuff here now. So this is called volatile and sideways price action, where basically trades in big chunks within a large range, and it can move quite a bit within this large range. Now, one of two things will happen from here. Either the market quiets down, recovers itself, gathers itself, and then starts working higher from here, and most likely will move into quiet and trending again. Most likely will move into quiet and trending if it moves to the upside and is able to clear above 2015 highs. Now, as we look back in 2011, that actually took quite some time before it settled down and started to trend in that manner again. So we may be seeing volatility for a number of years before it starts to quiet down and does what it does the majority of the time, which is quiet and trending uptrend. But being that this market, this rally has gone from 2009 up to now, this one is getting a little long in the tooth. We're already getting up to the point where this thing is closing in on 7 years old, which is nearly historic. Now, again, we have strange consequences coming into the markets through quantitative easing, and that can either be good or that can be bad. My sense is that eventually this thing is going to revert back to the mean in a very rapid fashion, but maybe not just yet. Now, if we do start to revert to the mean, what will occur is that we will start to see the market starting to trend to the downside. It will not lose its volatility. It will retain all of this nasty price action, but instead of going sideways within a box, it's going to start to move to the downside. Now, if you want a good example of what that looks like, you can go back to here, back in the end of 2007, and we sort of know what happened there, right? So this is what happens when markets fall from a volatile and sideways market, which is what we had back here in 2007, and then that transitioned into volatile and trending. And volatile and trending only occurs to the downside. We had the same exact thing happening back here in 2011, where we went into a volatile and sideways period, and that eventually ended up resolving to the upside. So now here we are. We're trying to figure out what's going to happen next. And this is why right now, for now, we're going to be staying in this volatile and sideways pattern until it escapes this pattern and starts to show us which way it's going from that point. So that's it for today's Market Minute. Thanks for listening, folks. Have a great weekend. Enjoy options expiration and all the volatility that comes with that. And we'll see you back here on Monday. Take care.